Welcome to today's Explainer. We're jumping right into a massive structural shift happening right now in the AI market. What we're looking at is astronomical paper wealth about to collide head-on with a very harsh cash reality. So let's unpack the mechanics of this, and we'll keep it bold, focused, and strictly business. Here is our roadmap for today. We'll quickly move through 1. The AI liquidity bubble. 2. The trillion-dollar IPO wave. 3. Late cycle warning signs. 4. Macro headwinds like inflation and oil. 5. The 2026-2027 danger zone. And finally, 6. The investor's defensive playbook.
Section 1. The AI liquidity bubble.
Okay, to really grasp the impending threat to your portfolio, we first have to distinguish between a solvency bubble and a liquidity bubble. Back in 2000, we had a profitless solvency bubble. Companies went public with zero revenue, and naturally, they went bankrupt. Today is completely different. Today's AI leaders like Nvidia and Microsoft are incredibly profitable, real businesses. But here's the catch. They've generated trillions of dollars in unspendable paper wealth. Eventually, founders and early investors are going to need to liquidate those shares to pay taxes or, buy their third mega mansion. And if too many of them try to sell at once and there just isn't enough fresh cash waiting to buy, the price collapses. And that happens completely regardless of how amazing the underlying AI technology actually is. Just think about the sheer, undeniable scale of this expenditure. Big tech firms are projected to spend a staggering $650 billion on AI infrastructure this year alone. That's a massive, massive capital outlay. If that $650 billion doesn't translate into equivalent near-term revenue, it creates this huge structural crack beneath the entire market valuation. It's essentially a foundational vulnerability that's just waiting for pressure. Section 2. Trillion-dollar IPO wave.
We are talking about absolute market-altering titans here. SpaceX is targeting a $1.7 trillion valuation, and they're looking to raise about $75 billion. Then you have Anthropic, the creators of Claude, filing for an October IPO near a $1 trillion valuation. These two listings alone are expected to vacuum $200 billion right out of the market. To put that staggering figure into perspective, that is greater than all IPOs combined from 2022 through early 2026.
Now, Wall Street doesn't just have $200 billion in idle cash sitting in checking accounts waiting for these IPOs to drop. That capital has to come from somewhere. Historically, investors parked their money in proxy trades. We're talking the Magnificent Seven, like Microsoft and Nvidia, because they couldn't own pure-play AI giants directly. But now, capital is going to have to violently rotate out of those proxy tech stocks to fund these new pure-play giants. And honestly, it doesn't stop with active stock pickers. We also have to factor in the passive money. When a behemoth like SpaceX enters the NASDAQ 100, index funds will be structurally forced to rebalance. They literally have to blindly sell portions of other stocks in the index simply to make mathematical room for SpaceX. This creates a mandatory price-agnostic selling pressure across the entire board.
Section 3. Late cycle warning signs.
Now, we aren't just making educated guesses about the resulting selling pressure. Institutional heavyweights are actively sounding the alarm. When figures like Ray Dalio point out that current bubble indicators are hitting historical extremes last seen before the crashes of 1929 and 2000, well, it's a really clear signal. The smart money is noticing a profound transition in the market psychology, shifting away from reckless growth and heavily toward aggressive capital preservation. Let me give you a perfect, concrete example of this late cycle psychology in action. Broadcom recently reported absolute knockout earnings. They had record revenue, they doubled their AI-related earnings, they beat all Wall Street expectations, and yet their stock crashed 12% overnight. Why would it do that? Because the market had already priced in perfection. In a late cycle market, good news is no longer rewarded. Investors are actively looking for any excuse to hit the sell button and take profits, basically playing the classic buy the rumor, sell the news game. Section 4. Macro headwinds. Inflation and oil. We are currently trapped in what's known as the good news is bad news paradox. Usually, the Fed cuts rates to save a wobbling market, but today, employment is strong and inflation is hot. This completely handcuffs the Fed. They simply cannot afford to print more money to rescue falling tech stocks. They're basically forced to keep interest rates punishingly high just to combat rising prices. Adding a layer of severe geopolitical risk to this is the energy sector. Think about this specific vulnerability. 20% of the world's oil flows through the Strait of Hormuz.
Goldman Sachs is modeling that oil could potentially hit $150 to $160 per barrel if there are disruptions. Historically speaking, almost every major market crash is preceded by an oil spike. Why? Because really expensive oil acts as a crippling, unavoidable global tax on every single business and consumer. If oil spikes while inflation is already running hot, the Fed will be completely paralyzed, which perfectly sets the stage for a rapid correction. Section 5. The 2026-2027 Danger Zone. Let's actually map this timeline out. June 2026 brings the SpaceX IPO, which will likely mark peak market hype, but the true danger hits a few months later. In December 2026, SpaceX's 6-month insider lockup expires, and that's followed by Anthropic in April 2027. This triggers massive, consecutive waves of insiders legally rushing for the exits, desperately converting their paper will to cash at the exact same time.
In this wave of insider selling aligns perfectly with the midterm cycle risk. The late 2026 to early 2027 window overlaps exactly with the second year of the U.S. presidential cycle. Since 1933, this specific year has been historically weak with a staggering 90% accuracy. During this incredibly fragile window, initial earnings reports from these newly public AI companies are going to roll in, and the market will finally be forced to mercilessly separate the businesses generating real sustainable AI revenue from those that have been coasting purely on hype.
Section 6. The Investor's Defensive Playbook.
So, knowing this storm is gathering, what do we actually do? Well, instead of succumbing to retail FOMO, professional investors have to adopt a highly disciplined posture. Here are 4 vital strategies. First, avoid buying into the IPO hype. Remember, you're essentially just acting as the founder's exit liquidity. Second, implement strict exit management. You need to use tight stop-loss orders on every single position to prevent devastating drawdowns. Third, actively monitor where the institutional money is flowing. Never hold a stock purely on emotion. And finally, if you preserve your cash right now, you're going to be in a prime position to capitalize on the correction and buy truly high-quality companies at a steep discount. I want to leave you with this absolutely critical question. Is your portfolio actually prepared for this trillion-dollar exit tide? Thank you so much for joining this explainer. Take time to evaluate your risk, stay profoundly vigilant out there, and whatever you do, don't get caught holding the bag when the liquidity mirage finally evaporates. We'll see you next time.